All right. So, welcome to another episode on Mr. Candy Crypto Talks. Right. So, today I'll be talking about portfolio management slash position sizing. I'll be talking about portfolio management slash position sizing. So, before I continue, firstly, it would be for your own good if you hit the subscribe button, turn on the post notification in case I'm posting another video, so you can what be among the first people that will get notification of the new video. Secondly, I am not a financial advisor, so whatever you see here, whatever you hear here, make sure you what do your own research before you what apply. Right. Now let's go straight to the point. So, according to Investopedia, position sizing refers to the numbers of units invested in a particular security by an investor or trader. You see, a security is like an asset, just like cryptocurrency, just like gold. That's what a security is. So, position sizing is the number of units invested in a particular security by an investor or a trader. Right. So, I'll go into details later on. So investors uses position sizing to determine how much of a particular asset they can purchase to control risk and maximize profits. Right. So before you take a particular trade, you should what weigh the risk reward ratio. So if your potential profit on that particular trade outweighs your potential loss, then it's a good bet. But the moment your potential loss outweighs your potential profit, the risk reward is not good for you. So I won't advise you take that trade, right? So, no matter how big your portfolio is, you need to know how to manage risk well to prevent your account from blowing up or to protect your account from what heavy loss. Right. So, you see the profit you've been gathering for days, months, weeks, years, you can blow it away in less than 10 minutes if you don't know how to manage risk well. Okay, so this is a live market and it is what's very risky. You have to be very, very what? Very, very careful. So trading has a lot to do with emotions because money is involved. Well, when you're making money, you want to make more. When you're losing money, you are in a fix. Let me explain. So when you are in a losing position, you are caught between closing the position and taking the loss and leaving the losing position what to recover. You see, this kind of feeling is what is more common and prominent when you are what trading the futures market, where you have a what a liquidation price. Right. So when you are in a losing position, you are caught in between: should I close this position and cut my loss, or should I just leave it since the market has a what on potential to recover? Now, as we are what thinking about that, you are keeping another eye on your what on your liquidation price. Okay, so it has a lot to do with what emotions, but as a trader, you need to know how to balance things, how to what balance things and what how to think with your head and not your what heart. Okay, so you do the right thing and not what you think is the what is the right thing. Okay, and when you are in a winning position, you are caught in between taking profit and waiting for more profit. Okay, you are in a trade, you've made 50%. Now your greed is telling you, I can still make more, let me wait. I can still make more, let me wait. You might end up losing that 50% you have. Yeah. So here, greed and fear, patience and impatience are the four major emotions that comes to play in trading and investment. Greed when you are making money, fear when you are losing, patience and impatience. It's either this patience and impatience has to do with what investment. There are times whereby okay, you've been holding a particular coin for maybe 4 weeks. There's no mean what incredible pump on the coin. So you sell off like 1 or 2 days later, it starts pumping. So that's impatience. Right. So, as an active trader of the market, if you want to grow your portfolio quickly, follow these techniques. So, I'm starting up now. So, I want you to what pay apt and close attention at this point, right? So, yeah, I'll be talking about and going into details on how you can what properly size your portfolio, how you can what properly manage risk while trading. Firstly, don't use more than 2% of your portfolio to trade the futures market. It's too dangerous. if you go all in the futures market with 100% of your portfolio, one long red or green candle can send you back to your village. Very, very possible. So when it comes to the futures market, that's why we have something like leverage that gives you the ability to what, use your small capital to what, to control a bigger capital, right? Okay, you are trading an account size of maybe $1,000. Okay, so 2% of $1,000 is about what, $20. With 10x leverage, that's $200 on a particular trade. Do you understand the point? So, and if you are trading with $10,000, 2%, that's about $200. 10x leverage or 5x leverage gives you the ability to control what, over $1,000 or $500. So that's still pretty good. But when you go all in, like take put all your portfolio in a futures market, let's say talking about the crypto market now, there's a what, slight move from BTC and market turns red and you are in a what, a long position. Then the market prints one long red candle and it eats your liquidation price. That means all your life savings, everything you've worked for, wipes away, and there's nothing you can do about it. There's absolutely nothing you can do about it. So that's why you don't use more than 2% of your portfolio to what, to trade the futures market, and also trade with what you can what, afford to lose. Okay, so let me explain it this way. Now you have a what, a $10,000 portfolio. Okay, and you put what, maybe 2% each in four trades. 2%, that's $20. With 10x leverage, that's $20 in four trades. Even if you lose 10% on everything, you just lost about just 10%. If the total loss on those four trades is 10%, you just lost about 10% of the 2% you dropped. So that cannot have any significant impact on your what, your portfolio. Do you understand? So when it comes to the futures market, you don't trade with more than 2% of your what, so that you can what, manage risk and what, maximize your profit. Because the bigger your position size in the futures market, the bigger your potential loss and the bigger your potential what, profit. Okay, so you should know how to what, balance your risk and what, and your reward ratio. Number two, don't put all your eggs in one basket, and also don't put it in too many baskets. Don't put all your eggs in one basket, and don't put it in what, too many baskets. Okay, now your account size is $500 to $1,000, and you're holding 10 to 20 tokens. That's way too much. Okay, that's way too much with a $500 to what, $1,000 account. So what about that $1,000 in just one or two coins or trade? Not futures now, not futures. I'm talking about the crypto market, not futures now. Now in what, the sports aspect, where you what, hold a particular coin for a particular duration and allow you to what, appreciate. So that way your portfolio can see visible response to market movement both positively and what, negatively. That's why you should measure the risk reward ratio before you put your money in a particular coin. So take for instance now your account size is $1,000. Instead of putting that $100 in 10 trades, divide it into two, $500, $500. Put it after you've what, made your research and you've found two gems. Put it, those $500 each in those two gems, right? So if one of those gems goes 50% up, your entire portfolio is already up by what, 25%. If one of those gems goes 100% up, your entire portfolio is already up by what, 50%. So even if the other one is what, going down, the other one will what cover up for the loss of that one with the profit. Do you understand? So $1,000 account size with two coins. If one of them goes 50%, your portfolio is up already by what, 25%. One of them goes up by 100%, your portfolio is up by what, 50% already. So by applying this method, you can easily see steady growth in your portfolio. Don't forget, measure your potential profit and loss before you invest in any cryptocurrency project, because the crypto market is very volatile. So if the potential loss is greater than the potential profit, the trade does not worth your money. Your potential profit your potential profit ratio should be greater than your potential loss ratio. Right? In conclusion, don't risk more than 2% of your portfolio on the futures market. So I will be what summarizing everything I've been saying this morning. Now, number one, don't risk more than 2% of your portfolio on the futures market. And two, don't put your eggs in one basket and don't put it in too many baskets. Now, so let me chip this in. Three, don't what when you are trading with, know your, if you are trading with less than $500, right? Advisable to hold just one coin, hold just one. If you are trading with about $1,000, divide it into two, hold two. With 2,000, that way you can what easily what grow your portfolio. The growth will be what will be faster, because in crypto, the bigger what your capital you're investing in, the bigger your potential what profit and what and your potential loss. So that's why like I said earlier, you should what measure your risk reward, know what your potential profit and your potential loss in a particular trade before you what hop in, right? So thank you very much for watching. Don't forget to what subscribe for this channel, um click the like button, and what leave a comment below in case you have any questions, right? So thank you very much for watching. Look forward to another what time out with you.